Hello, my name is Jace Brown. I'm an attorney with Chiesa, Shaheni, and John Tomasi in West Orange, New Jersey. Today I'm going to be giving a short presentation on what is an original under Insuring Agreement E of a financial institution bond. For those unfamiliar with the financial institution bond, a financial institution bond is a fidelity bond that covers loss for financial institutions associated with, among other things, counterfeit documents, forged documents, and altered documents. The objectives of this presentation, number one, is to understand that not all financial institution bond forms define the term original. The older ones do not define the term original, and the newer ones do. Second objective is to understand the purpose of the original requirement in Insuring Agreement E, which we will discuss momentarily. And the third objective is to examine case law addressing what constitutes an original under Insuring Agreement E in those circumstances where the term is undefined and in those circumstances where the term is defined. There's been multiple revisions to Insuring Agreement E over the years. The term original was not defined in the 1986 version or prior. 2004 was the first version that defined the term original, and that same definition of original remained in the 2011 bond. I believe what precipitated that change was the advent of the internet. As you will see in some of the cases we're about to discuss momentarily, the real issue when dealing with what constitutes an original is whether electronic documents constitute originals, and that was likely the reason for the change in 2004 to clarify that electronic documents did not constitute originals, which we will get further into here momentarily. You still, even though the bond form in 2004 and 2011 defined the term original, you still need to understand what constitutes an original whenever the term is not defined in the bond. And the reason for this is because pre-2004 bonds are still used today, so you will still come across the issue. Additionally, as you will see in one of the cases we're about to discuss, sometimes the term original is negotiated out of the bond for various reasons by the parties, and in that circumstance also you would need to know what constitutes an original under Insuring Agreement E. So this is the current language of Insuring Agreement E. This is the 2011 version, and I'll just cover this briefly. The language states that the bond covers loss resulting directly from the insured having, in good faith for its own account or for the account of others, acquired, sold, or delivered or given value, extended credit, or assumed liability on the faith of any written original of one of these enumerated documents A through H, which bears a handwritten signature which is material to the validity or enforceability of the security, which is a forgery or is altered, but only to the extent the forgery or alteration causes the loss or is lost or stolen. So this provision right here, pre-2004, did not have the term up here written. It didn't say any written original, it just said any original. Did not include the word written prior to 2004, and the term original, that was a lowercase o prior to 2004. It did not have original defined. So it just said any original. That was the previous language, and then the written original requirement was added in 2004. So this provision typically covers a circumstance where a bank lends money, and as consideration for the lending of that money, the bank takes collateral security in the form of one of these documents in A through H, and that document that the bank takes as collateral turns out to be either a forgery or an alteration. For purposes of this presentation, we're not dealing with lost or stolen instruments, but forgeries and alterations, that is typically what is covered by this particular provision in Insuring Agreement E. And then this next paragraph down below says actual physical possession of the items listed in A through H above by the insured, its correspondent bank, or other authorized representative is a condition precedent to the insured's having relied on the faith of such items. And this just means that the bank, whenever it lends the money, it is required to possess the instrument. It's required to possess the instrument before it can lend funds. If it doesn't have actual physical possession, then there is no coverage under Insuring Agreement E. And then the very last paragraph states that a reproduction of a handwritten signature is treated the same as a handwritten signature. An electronic or digital signature is not treated as a reproduction of a handwritten signature. And basically all this means is that a stamped signature is fine, but an electronic or digital signature is not permitted, and there would not be coverage with such a signature. The current 2011 version of the financial institution bond defines original as the first rendering or archetype and does not include photocopies or electronic transmissions, even if received and printed. So this is the same definition that was in the 2004 version, and I think this definition is pretty clear-cut. Doesn't include photocopies and doesn't include electronic documents. I don't foresee much case law addressing what constitutes an original whenever you're dealing with this definition. The reason for the original requirement is to avoid what is known as moral hazard, which is a very big factor in insurance. Basically, moral hazard is that you don't want to incentivize individuals or entities to have lackadaisical business practices or otherwise be negligent. So you don't want, for example, if a car owner has car insurance, perhaps they are more likely to engage in risky driving behavior. Same with life insurance. If somebody has life insurance, are they more likely to engage in risky behavior because the consequence of risk taking, is borne by the insurance company and not by the individual. The individual no longer has a concern that if something were to happen to them, that the family the individual's family would be unsupported and wouldn't be taken care of. So it's the same thing with the original requirement. You want to incentivize banks to have sound business practices, and you want them to have possession of the original document if they're going to lend money based on the strength or the value of that document, whatever that document is. And I won't get into the details, but experts almost unanimously agree that it is easier to detect a forgery or alteration in an original paper document versus a photocopy, fax, electronic transmission, or a scan. So next I'm going to discuss some cases. Each of these cases address what is an original under Insuring Agreement E. The first set of cases, the term original was undefined in the bond, and the second set of cases that we'll discuss, the term original was defined in the bond. So this first case is Hamilton Bank versus Insurance Company of North America. And in this case, a bank loaned $1.4 million to 9 Mexican companies to finance the purchase of American goods for importation into Mexico. As collateral for extending the loan, the bank required that the companies provide promissory notes, sales invoices issued by the exporter, and bills of lading. And with respect to the bills of lading, the bank accepted photocopies. The companies defaulted on the loans, and it was discovered that the signatures on the bills of lading were forged and that the description of goods was inaccurate. The bank filed a claim under its bond, which was denied by the insurance company, and the parties went to court. And the question before the court was whether the bank had possession of the original bills of lading at the time it made the loans. And in the trial court, the bank argued that the term was ambiguous and that the term original was capable of various meanings in today's commercial environment. And the court rejected that argument and said that even if the term original was capable of various meanings, mere photocopies clearly were not originals. So the court held that the claim was properly denied by the insurance company. The second case is Reliance Insurance Company versus Capital Bank Shares. In this case, there was 2 insurance companies that issued financial institution bonds to 2 banks. Each bank issued a loan to an individual secured by stock certificates, 60,000 shares of AIG stock, $30,000 shares to each bank. The customer defaulted on his loans, and the banks discovered that the stock certificates were not genuine. Both insurance companies denied the bank's claims under the bond, and the parties ended up in court, and the question before the court was whether the banks had possession of the original stock certificates whenever they extended the loans, and the court held that the possession of the bogus stock certificates that was not possession of the originals. The court held that because the stock certificates were fraudulent, fake, bogus, that was not possession of the originals, as they were not legitimate stock certificates. So the takeaway from this case is that a bogus instrument or a fake instrument is not likely going to be considered an original. And I think the basis for that is, how can it be an original if it's fake, if it's not a legitimate document? So this particular court held that a bogus stock certificate clearly was not an original. The next case is Bank Insured Incorporated versus Marshall Bank. In this case, a customer went into a bank seeking a loan to complete the purchase of a minor league hockey team and to refinance another. As security for the loan, the bank required 2 personal guarantees from 2 of the customer's business associates for $1.25 million apiece. 2 days prior to the bank dispersing the loan, the customer called the bank's president and said that he was flying to Florida to have the guarantees executed by his 2 business associates. On the day of the disbursement, the bank received faxed copies of the guarantees from the customer, and the bank dispersed the funds. Thereafter, the customer defaulted on the loan, and it was discovered that the signatures on the guarantees were forged. The bank filed a claim under its financial institution bond, which was denied by the insurance company, and the question before the trial court was whether the bank possessed originals at the time it dispersed the loan funds, and the court found that the bank's possession of faxed copies clearly did not constitute possession of originals. Transportation Alliance Bank versus Bank Insured. This is the case where it gets a little bit hairy. The plaintiff in this case was a bank. It was in the business of factoring, which meant that it would purchase accounts receivables from entities at a discount, providing the customer with immediate cash flow, and then the bank would receive the full amount of the accounts receivable whenever they became due. One of the bank's factoring customers was Aero Trucking Incorporated. As collateral for the bank's purchase of accounts receivable, Aero executed an accounts receivable purchase and security agreement. And pursuant to the AR purchase and security agreement, the bank would purchase the accounts receivable on a rolling basis, and Aero would provide the bank with electronic account statements of its current accounts receivable. Sometime after the relationship began, the bank discovered that Aero had been altering the electronic account statements and misrepresenting the amounts owed from Aero's customers. The bank filed a claim on its bond, which was denied by the insurance company, and the trial court, the insurance company argued that the bank did not possess the originals of the accounts receivable statements, and therefore coverage was properly denied. The court disagreed. The court found that the bond form at issue was a 2011 version, which had been altered by the parties to remove the definition of original from the bond form and to also remove the requirement that the document be written. The court said that based upon the plain language of the bond, the electronic account statements constituted originals because they were generated electronically. There was no paper version of the account statements. The account statements were generated electronically. The court noted that in today's banking world, where most people do all of their banking online, electronic documents are widely considered originals. And the court also found support for its ruling under Utah's Uniform Electronic Transactions Act, the UETA, which will be discussed momentarily. So the second set of cases, the courts were faced with what is an original whenever the term was defined in the bond. First case is Valley Community Bank versus Progressive Casualty Insurance Company. In this case, a customer of the bank applied for a loan for $4.25 million. As collateral, the customer pledged securities he held in a broker-dealer account. In truth, however, the customer did not own the securities. Rather, he had conspired with an employee of the broker-dealer who assisted him in electronically altering the statements from the broker-dealer and changing the owner name on the statements. The co-conspirator then took those altered account statements and provided them to the bank on the customer's behalf. The issue before the court was whether the PDF version of the account statements which the co-conspirator provided to the bank qualified as originals. The definition of original in the bond was the first rendering or archetype and does not include photocopies or electronic transmissions, even if received and printed, which, as we discussed earlier, this is the definition in the 2004 and 2011 bond. The court held that clearly under this definition, the PDF version of the account statements was an electronic transmission and therefore did not qualify as an original, and thus the insurance company properly denied coverage. And the last case is Crown Bank JJR Holding Co. versus Great American Insurance Company. In this case, the court was required to address the definition of original in the context of Insuring Agreement D, which shares the same definition as Insuring Agreement E. In this case, a bank had policies in place to permit wire transfers via email or telephone. When a customer requested a transfer via email or telephone, the bank would have the customer sign and return a wire transfer authorization form. When the bank received the form, the employee that received the form was required to phone the customer to verify that the signature on the wire transfer authorization form was valid. The bank president's wife had submitted a legitimate wire transfer authorization request, and shortly after the legitimate request, 13 additional requests were sent to the bank from an email address identical to the bank president's wife, but with an additional I. Instead of following the bank's procedures regarding wire transfer requests, two employees of the bank processed the request without phoning the bank president's wife to confirm that it was her that made the requests. In total, $2.7 million was transferred to a bad actor. The bank made a claim on its bond, which was denied by the insurance company, and the question before the court was whether the wire transfer request constituted an original for purposes of Insuring Agreement D. And the definition of original in the bond was, again, the first rendering or archetype and does not include photocopies or electronic transmissions, even if received and printed. The court found that based upon this definition that the PDF wire transfer request forms were clearly not originals because they were electronic transmissions based on the plain language of the bond form. E-sign and UETA. E-sign is the Federal Electronic Signatures in Global and National Commerce Act. This is a federal act, and then the UETA is the Uniform Electronic Transactions Act, which is the state version of e-sign. So the reason I'm discussing these is because if you are faced with a circumstance where you have a bond form where the term original is undefined, e-sign and UETA both may support a finding by a court that the term original would include electronic documents. And the reason for that is because both e-sign and UETA provide that notwithstanding any statute, regulation, or other rule of law, a signature, contract, or other record cannot be denied legal effect, validity, or enforceability solely because it is in electronic form. Nor can a contract relating to such transaction be denied its legal effect, validity, or enforceability solely because an electronic signature or electronic record was used in its formation. However, the acts expressly state that they only apply to transactions where the parties have agreed to conduct transactions via electronic means. So when you're dealing with a bond form that defines the term original, which expressly states that it does not include electronic documents, then clearly the acts are unlikely to apply. However, again, if the term original is undefined and the parties have agreed to conduct transactions via electronic means, then that would lend support for the court finding that the term original does in fact include electronic documents. In summary, old bond forms do not define the term original. New bond forms do. Sometimes parties remove the definition of original from the bond form. In either a circumstance where you're dealing with an old bond form or you're dealing with a bond form where the parties have negotiated the definition of original out of the bond form, you're going to be faced with the question of what constitutes an original under Insuring Agreement E. The purpose of the original requirement is to avoid moral hazard and to make banks responsible for losses that could have been avoided with sound business practices. Experts uniformly agree that it is easier to detect a forgery or alteration when in possession of an original. The current bond form defines original as the first rendering or archetype and does not include photocopies or electronic transmissions, even if received and printed. This definition is pretty clear that it does not include photocopies, fax copies, scans, documents, or electronic transmissions. When the term original is undefined in the bond, case law that we've discussed suggests that photocopies are not originals, bogus instruments are not originals, fax copies are not originals, and electronic documents may be considered originals if there is not a paper original and where the document was generated electronically. Both e-sign and UETA only affect the analysis when the term original is undefined in the bond, and if the term is undefined in the bond, they would likely support a finding by a court that the term original does in fact include electronic documents. So that's it for my presentation. I appreciate your time very much, and certainly reach out if you have any questions about the presentation, and I'm happy to answer any questions. Thank you very much.